S&P 500 daily chart. Up above here, S&P 500 weekly chart. What we are going to say is that bull rallies, even with the bad unemployment number, the unemployment number at 92.2% is a terrible number. And what we have is that when you make a oversold market and bull rally is in play, bull rally is overbought, bull rally 4-day buy signal, as I said clearly yesterday on this particular public indicator, is that you were at 93.4% overbought. And it's inevitable that when oversold to overbought, you're going to get these reversals in bull rallies. The bull is in play for one reason, because they're back and they're fully invested in the market again. And when we have 9.2% unemployment rate, the bull will go into what we call denial. Now, the bull rally is that the SMF has a mathematical formula with weekly moving averages. When we undercut it 1 week, 2 week, 3 week, 4 weeks to this very bottom over here, which happens to be what? It happens to be the long-term 2,000 and support levels down here. This is the long all of the year of 2011 is right here on a weekly level. And when we called that top market to the, we were so overbought on the S&P, we had a, I wouldn't say that the correction was all that much. It was 100 and some points, big deal. And the thing about it is, this weekly bar is called an indecision. It's called a weekly doji. It means that they're not buying up here at the top. They're not selling down. It's indecision. A lot of indecision. This bar will not be confirmed. Either way, it can gap up and or it can gap down. And basically, with the close above the 10-week here and being above the 10-week here, that's going to be the support level of 1309 on the S&P, 1310 per se. That's going to be the bull rally support level, okay? Outside of all of the economic data. The economic data isn't good. You're going to have the overhang is that we had 1 week up, but look at the amount of weeks we had down. 1 week, 2 week, 3 week, 4 week, 5 week, 6 weeks, 7 weeks, 8 weeks to the bottom with a 3 week, 2 week consolidation of the long-term trend. We were oversold. It was time to get bull. But we're also overbought, and then we had the bad jobs neighbor come in, and I said our neighbor. That's all of our neighbors who are not working. And people deserve to go back to work. Now, the bull, when bull rallies, long-term bull rallies with corrections, because that's what they are. Here's the daily breakout. Here's the daily reversal. There's only 1 day reversal here with the amount of, these are the double bottoms, and it's only, but the support level is going to, in the bull rally, because it still remains a bull rally, but it's going to have support levels down here at these key moving averages now. And the bull, what we call a crossover rally, is where the daily moving averages, a 10-day crosses above to the 100, that's bull. It crosses above up to the 100-day and the 50-day moving averages. There's a 100-day moving average here. There's a 50-day simple moving average. You've got the yellow line is 100-day, and then you got the white line there intersecting. This is ultimately going to be the support level on the S&P where these moving averages are on the daily, and that's going to be that trend line right here, which was key support over here that we had the 4-day rally from and we came down. Now, one thing that we want to be mindful of, that when you look at the daily, that we're overbought. Bull rallies get overbought. Bull rallies have to pull back. The discount model to horrible economic data at 9.2% unemployment. Last week you had the ISM and the PMI, and that fueled that rally. My point of it being is that the bull rally will get support levels at both this trend line here and these weekly moving averages. We've only had, from the long-term correction, and if you go to stockmarketfunding.com, there's a search box. Just type in S&P 500 index, and it'll bring up all of our analysis, just like we're doing it before the fact. Not after the fact, before the fact. Before the fact. Before the move happens. The analysis is 100% on. It is the best out here. And why do we say that? We don't say that MMTs unless there's a reason for it. And we have to prove it before markets make moves. And the analysis must be done before the market makes moves. And that's how people should use the scorecard and grade it accordingly. Because the reality is we live in it. We called that move. But we also called the upside. Now, for a bull case to continue and or a bear case to come in. So let's look at the bull case. The bull case is you come down, you bounce. Okay? That the market discounts in the short term the 9.2% unemployment rate. They discount it. You come down, you hit it. The amount of complacency in the market. Complacency is complacency. And what does complacency mean? It means that everybody's back to the bull side. But when we were correcting up here, as we started the correction over here, everyone that was a bull changed to a bear, and we had higher fear indicators. So there's little fear. The people are trying to justify that U.S. citizens don't have to work. Well, why don't you go ask your neighbor what he feels like because he can't get a job, he or she. I don't think they feel that good about it. I'm going to draw another trend line here on the weekly, which is right about here. And basically, this is what we call the neckline reversal that came down, and we came up and we tested it. We had a huge down move in the S&P, and we bounced very quickly. That's always going to happen in bull rallies. Does it mean that the bull is right? No, the majority of bulls are wrong. We are not overbought on a weekly of exuberance, but on the daily short term, we are. And we always have to rely on the daily because it tells us that at 93.4%, that's extremely bullish on that reading. Here, let's get that reading in here. That's this down here, 93%, which was yesterday. Now it's at 90. It's still overbought. It's still overbought. This was the peak. That's now every bull rally has to pull back to support. And then because of the length of the bull rally, and what is the length of the bull rally? Bull rally started back over here in 2009. So we have a long bull rally with market corrections. In 2011, we've had a couple of them. The bull rally goes long term with the rising 200-day simple moving average. Not only that, when you look at the weekly here, you continue to see that the weekly bull rally is very long. Very long. So when you get overbought, you correct, and when you get oversold, you rally. We have remained in a bull weekly buy signal since 2010 right here. That's that blue bars. It's been a long, great bull rally. Now, what has happened today, with that jobs report, you've got the debt ceiling that they're going to come out with all of these little fancy things that they're going to try to do for the U.S. public. Don't believe in it. And I can tell you why. There's a lot of reasons why. And if you want to know why, and you're an innocent bystander just watching the video, then sign up at stockmarketpundit.com. Send us an email. We'll be happy to explain it to you at that time. We will not go into it right now. But we will tell you that the bull rally in the current cycle, we've had one up day. This is a weekly, one up week. And you're back above what we classify 10-week and 20-week moving averages that you have to stay and maintain a closing price 4 consecutive weeks in a row to confirm that the bull rally is the bull rally. You have to have that. And it can't be that it comes down below it 1 week, no, it's got to be 4 consecutive closing weeks. So you had 1 week here, and now you have 2 weeks. Same thing. The weekly moving averages cross over the 20. It's still below it. So here, let's micro this weekly chart out where you can see it better. The blue line is the 10-week, and the red week is the 20-week. Red line is the 20-week. When you got below it here, 1, 2, 3, 4, this is where bulls turn into bear reversals from the original reversal, that they get down into what we call the bear reversal, because you have to have that many weeks below it to confirm it. And it's our math that works with weekly moving averages, and we're never wrong on these. Okay, and how do you want to validate it? Go look up the indexes and validate the analysis. This is going to be the support level. When you get this amount of bull that comes in, and the second half recovery and everything else that goes there, that bull sentiment will go into denial about the jobs report. And what they'll do, the bull will discount that. I can tell you it's not good. However, the bull has a discounting denial model that puts that on the sideline, and all attention is going to go on Mr. Obama now and Congress now, and that they're going to have the greatest resolution. But let me tell you something, for the bull anyway, the bear has to still be extremely careful, because we're going to come down, and this is going to be our support levels here. And it takes a period of time that the majority of the crowd really believe about the greatest second half recovery. Well, let me tell you, because of the 9.2%, the Federal Reserve will not be barbecuing and having a good time on their patios this weekend. They're going to be figuring out, how do I do QE 2.5? QE 2.5. That's what the bull has going. And the bull is trying to rely on what will take. If they do another QE2 and intervene because of the weak jobs report, forward-looking months ahead, we are going to hit all-time highs in commodities. We're going to hit all-time highs in oil. The reason why oil went higher, the reason why commodities went higher, the reason why energy went higher was because of that artificial injection of QE2. The minute that the economy got weak, is they don't need to do a QE 2.5 to create another fiasco. What they need to do is bring jobs back to the United States of America. They need to give corporations incentive to hire. That's much better than doing their little stimuluses. And all the bulls can talk about today is, I need more government handouts. I need more government stimulus. No, that is not the answer. The answer is, given the incentives, given the import-export trade treaty, or not treaties, but agreements around the world, is they got to be leveraged over to the United States citizens. We need to pull workers back here. We need to make it where corporations want to pull it back. Now, that is the kind of stimulus that you want, bull. That is the kind of stimulus that you want, bull. Instead of all of this handout, all of this artificial price movement, that's not solving the unemployment. So, when it comes to bear and bull, the denial process, the earnings are going to be coming. They're going to be waiting on Obama. They're going to be waiting on Bernanke to inject QE 2.5 into the system. That will really make it fail down the road. Yes, short term it's good for the bull, but longer term, you think that this last little correction was bad right here for several weeks in a row? It'll be much worse in that scenario. Can it be avoided? Yes. The chances of it happening are slim, but there are ways that if Congress comes around and does the right thing, that we could avoid, and we could actually get a bull market again. We came up to major topping levels. This every bull rally needs to pull back 3 or 4 days. Just like when you're putting in bottoms, you rally up, then you pull back a few days and test it. Well, when rallies go straight up parabolically, they need to have 3 or 4 down days to come back and test support and then move higher. There are bull and bear trends. However, we're going to be dealing with the earnings. Earnings are going to be mixed starting Monday morning, July 11th. And the reason why this turned in such a narrow range day, this daily reversal makes us overall 4 up days in the week changes to very indecision. And it's called a doji, weekly. And how is it confirmed? Either it gaps below it and you never ever close above it, and this gaps down on a daily and you sell through the moving averages that would act as support. These are your support levels down here on the S&P. The weekly is also. So having said that, between bear and bull rallies, when you're overbought process, back to what we're talking about here, I'm going to conclude this, but on a daily level in short-term bear and bull cycles, you got to know when they're oversold and go to rally. You also got to know that when they get extremely overbought, you got to take some profits. You don't have to sell everything up here, but you got to scale out in overbought areas. And they pull back and they hold support. Hey, that's another story. And you're still in some of your positions. Should Obama do the right thing and we pull back and hit support levels, we would blow out all the way back up here to 1370 on the S&P, and we would make higher highs above. However, the earnings are also going to have to come in. So if you got the great rally like we did, we start selling into tops like yesterday, taking 50% of the money off the table, 75% of the money off the table, knowing that the pullbacks in here in bull rallies that start these as a new fresh bull rally. This was the bear rally. This is a new yearly double bottom low bull rally on the S&P. And new bull rallies that are born either make much higher highs and or much lower lows, and that it's important to know that we ran too far too fast. It's a good thing to sell into it. Learning how to short intraday, learning how to short gaps intraday, learning how to put these trades together, or knowing when, if you're a long-term investor, that when you got that bull rally back up here, it gave you a chance to start exiting. You had a gift. You have a chance to get out. That's the daily chart. The S&P 500 on the weekly is very indecisive. We are not on a weekly level overbought, but we are on a daily level where markets tend to trade day in and day out within volatility. We're overbought. And if that green line crosses over there, and we've had a 4-day buy signal in the last 4 days up here, the jobs report is being discounted. Earnings start on Monday. I always recommend with our particular traders who trades our capital, okay, is that we start selling into the top of rallies. We buy the bottom of rallies. We sell into them. We sell short intraday on stocks. We make money. We do all kinds of wonderful things here. And not only that, most importantly, my friends, around the world, is that the analysis is done before the fact. And we do it for our MMTs because that's who this is done for, the people that are in our school. It's just that the public just so happens to get to watch these live videos and analysis. If you really took the time to compare them and you went back and you looked at the dates, the timestamps, you did everything, you would know. You would know that SMF is the leader in market trading, technical, economical analysis, and that the scenarios are planned out before the moves. They're not after the fact. Everybody can say everything when something happens after it happens. That's easy to do. But what about before? And what about the trade scenarios and the risk management scenarios and the various different kinds of bears and bull ETFs and iShares and worldwide markets and so many other variable factors that go into top-rated analysis on index and equities and earnings and economic cycles and jobs reports and many other things. That is what an individual needs to do, to learn and do to protect themselves, because you can't believe what's on TV. You can't believe what analysts say. You cannot any longer believe what people would want to believe in the financial services industry. It's so manipulative and so corrupted that you got to have top-notch skills. And you've got to understand shorter movements, longer mid-term movements, longer-term movements, what a long-term bull rally is, or a long-term bear rally, and bear corrections with new bull rallies. And there's just so many things that you must do and learn. S&P 500.